Proprietary capitalism.
The movement from a monarchy to a more democratic form of governance supports the transition from mercantilist to free market theory. A weak government's role assures that markets remain transferable so participants are not hindered from making transactions. Governments operating under the proprietary form of capitalism would not be considered a principal beneficiary of policies and laws. Adam Smith is one of the first to present a weak state model. 33 Under proprietary capitalism, individuals are free to make economic production and consumption decisions. The government's role is limited to performing tasks for the public good, for example, national security, and to maintaining an environment that allows for a free-flowing economic system. Smith's invisible hand assumes that the nation is composed primarily of small, sole proprietary businesses. Each small business serves a small percentage of the total market. Government action interferes with the market's spontaneous order. Since small businesses dominate the competitive environment, organized societal groups also are assumed to be weak. No dominant group controls enough resources to influence the market, monopoly power. Chandler coins the term proprietary to describe this weak state, weak society capitalism form. 34. Theory expansion from classical economics to neoclassical economics is sometimes credited to the Alfred Marshall's work on marginal analysis. 35 The fundamental idea of Marshall's work is that the power of supply and demand generates market equilibrium. Market price equilibrium occurs when the quantity demanded equals the quantity supplied at a given price and given time, the point where the market clears. This school of economics assumes that the market is free of imperfection. An important variant stemming from the neoclassical theory is attributed to John Keynes. 36 Keynesian economic intervention responds to high unemployment in England that contradicted the classical assumption of full employment, Say's law. According to Say's law, a wage rate always exists that makes full employment possible in a capitalistic system. 37 Keynes argues that the employment level has no relationship to the cost to labor. Instead, an increase in aggregate demand serves as the primary incentive to hire more workers, which directly relates to the level of investment. Businesses will not hire more people to produce more products unless a demand for the surplus exists. The investment decision requires inducements such as, 1. The marginal efficiency of the capital, for example, the best return for idle cash, or, 2. The risk related to the loan payoff to finance the production that makes the rate of return acceptable. Through monetary, for example, prime lending rate, or fiscal policy, for example, state procurement policy, manipulation, the government affects total spending and total employment. Support for proprietary capitalism comes from the Chicago and public choice schools. Milton Friedman and the Chicago School proponents express concern about any concentration of power. Essentially, they believe affecting trade for a public good is impossible. 38 Unlike the Keynesian use of demand as an employment level determinant, Milton Friedman focuses on the equilibrium of the money market, known as quantity theory. Equilibrium in the money market is believed to be the necessary market condition for expenditures on goods, services, and securities. The public choice school also supports a limited state role. Public choice proponents are critical of any government intervention. In the minimal state model, the state's role should be limited to protection against force, theft, fraud, and enforcement of contracts. 39 All other state actions violate individual rights. Although the proprietary form is considered the theoretical foundation for United States capitalism, this form has several shortcomings. 40 At least 3 shortcomings associate with neoclassical theory. 41 These shortcomings suggest that the existence of this form of capitalism is problematic. First, neoclassical theory assumes pre-existing markets where one individual or group has oligopoly or monopoly power. The automobile and commercial aircraft manufacturing as well as consumer retailing are examples of oligopolies. General Motors, Boeing, and Walmart compete against Toyota, Airbus, and Target, respectively. Small businesses trying to enter these competitive environments face insurmountable barriers. For example, Walmart's 9,700 retail stores had fiscal year 2011 sales of $419 billion. 42 Even Walmart's suppliers are kept in line by the retail's purchasing power. In the mid-1990s, Rubbermaid raised the price charged for the company's products because a key ingredient's price increased by 80%. Walmart's solution was to give more shelf space to lower-priced competitors, forcing Rubbermaid to merge with rival Newell. 43 Clearly, Walmart's size creates economies of scale, enabling the company to sustain a cost leadership position.